Welcome to the deep dive. Today, we're tackling a bit of a surprising story from the stock market. One that's kind of stunned a lot of investors.
Yeah, we're talking about Build-A-Bear Workshop.
Exactly. You might think of them as, a fixture from 90s malls, maybe a bit of a throwback.
Right. But this 28-year-old company, a physical retailer, has seen its stock just explode.
It's truly wild. Over 2,000% in the last 5 years. It went from what, like $1 a share to almost $70.
hmm And it's beating out a lot of big tech stocks this year, which is really saying something.
It really is. But it's not just a stock market blip, is it?
No, not at all. It's a story about a major strategic turnaround. We've been digging into their latest earnings Q2, the first half of fiscal 2025.
And the results are pretty eye-popping.
They are. Build-A-Bear themselves called it the best second quarter and first half results in Build-A-Bear's history. Just think about that.
So that's really the mission for us today, for you listening. How is a company built on, let's face it, a very physical, hands-on experience? How are they achieving this kind of record-breaking profitable growth, especially now in this economy?
Yeah, we need to unpack what they call their purposefully evolved and diversified business model.
It definitely suggests this isn't luck, it's strategy, maybe even a master class in retail right now.
Okay, so let's start with the basics. The financial health. How are they actually doing?
Well, Q2 2025 total revenues were up 11%. That's over $124 million.
Which is solid growth. But the really telling part, I think, is the bottom line. Pre-tax income jumped 33%.
33% to over $15 million. That signals real efficiency gains.
Exactly. And that pattern holds for the whole first half, H1 revenues. Also up over 11%, hitting more than $252 million.
And earnings per share, that climbed about 45% to $2.11.
Wow.
Yeah. These aren't small bumps. This points to some fundamental improvements in how they operate.
And the profitability structure is fascinating here. Their EBITDA margin rate for the first half.
Yeah.
Nearly 17%.
Okay, put that 17% in context for us. Is that good for a retailer like them?
It's really good. That rate has more than tripled compared to the first half of 2019, before COVID hit.
Tripled.
Tripled. A 17% EBITDA margin is, well, it's remarkably high for a physical specialty retailer. It puts them closer, performance-wise, to some lean digital companies than your typical mall store.
That's incredible. What's driving that?
It speaks volumes about their efficiency. Think inventory management, labor costs. Plus, their store contribution margins are strong, over 25%.
Okay.
And they're also growing their higher margin commercial segment. That's mostly their wholesale business. That part grew 22% in the first half.
So they're building efficiency into the model from multiple angles.
Pretty much, yeah.
Yeah.
And the market sees it. Their confidence is obvious. They actually increased their guidance for 2025 revenue and pre-tax income.
And they expect this to be, what, the fifth straight year of record results?
That's what they're anticipating. And they're not just sitting on the cash. They're giving back to shareholders over $13 million returned through dividends and share buybacks just in the first half.
Okay, so the financials are strong, the efficiency is there, but let's switch gears a bit. A lot of their strategy seems built around something less tangible. Feelings? Nostalgia, even? How does that fit in?
That's the core of it, really. They've figured out their biggest asset isn't just plush toys, it's the emotion attached to them.
Ah.
So they're deliberately targeting what the industry calls the Kidult consumer, teens, adults. They're actively monetizing the brand's, quote, multi-generational appeal.
Kidults.
Right.
So grown-ups buying teddy bears.
Basically, yeah. Or at least grown-ups engaging with the brand. They understand that the connection someone formed maybe 20 years ago as a kid is now a really profitable relationship to nurture.
And they have data on this.
They do. This is where it gets interesting. They did a survey for National Teddy Bear Day. Get this. An overwhelming 92% of the people they ask still own their favorite stuffed animal from childhood.
92%. Wow. Okay, so people keep them.
They more than keep them. Listen to this stat. 86% admitted their teddy bear knows more of their secrets than their therapist.
No way, really?
That's what the survey said. And 67% said their furry friend actually helped shape their life plans.
Okay, that's deep for a teddy bear.
It is. But from a business perspective, that's an incredibly low-cost, high-retention emotional asset. It generates ongoing warm feelings towards the brand.
And it creates this natural bridge across generations, right?
Exactly.
Yeah.
The CEO pointed this out, the kids who first went to Build-A-Bear back in, say, 1997. They're now parents.
And bringing their own kids, completing the cycle.
Right, and Build-A-Bear is leaning into this hard. They're doing lots of collaborations that appeal directly to adult pop culture fans. Things like Hello Kitty, Pokemon.
I saw they mentioned upcoming plans tied to the Wicked movie sequel, too.
Yep, wicked for good. They know exactly which adult collectors will pay a premium for those licensed limited edition items.
Okay, so the Kidult strategy is key. Let's talk about the mechanics. How are they structuring the business to capture all this growth? They mentioned 3 pillars.
Right. 3 strategic pillars driving things. Pillar 1 is about expanding and evolving their physical stores, that experiential retail footprint.
But expanding physical retail seems counterintuitive right now. Expensive, right?
Usually, yes.
Yeah.
But their approach is smart. They're using what they call a unique capital-light partner-operated retail model,
Capital light, meaning?
meaning they aren't bearing all the cost of building and running every single new store themselves. They partner with others who operate the location. It shifts the heavy capital burden.
Ah, okay. That lets them scale faster without breaking the bank.
Precisely. And they are scaling faster. They just upped their goal for new locations in 2025 from 50 to at least 60.
Wow. And a lot of that growth is international.
A huge chunk. Of the 14 net new spots they opened in Q2, 86% were outside the U.S. They're now in 32 countries. Just added Georgia and Uzbekistan recently.
So they're becoming a global provider of this retail experience package.
That's a good way to put it. They provide the brand, the process, the magic, and partners deploy it.
But does expanding so quickly, and often through partners, risk watering down that core Build-A-Bear experience, the specialness?
That's definitely the balancing act.
Yeah.
But the sources suggest they're being careful where they expand. It's not just generic malls anymore.
Like what?
Well, partnerships. They have 33 locations with the Girl Scouts now. They're in all 22 Great Wolf Lodge resorts in the U.S.
Okay, so high-traffic, family-focused locations.
Right. And they're creating unique destination spots, too, like the remodeled Space in FAO Schwartz in New York, or that Hello Kitty and Friends workshop in L.A., which was apparently very successful.
And wasn't there something about a big Orlando location?
Yes, a multi-level, kind of one-of-a-kind flagship workshop planned for Icon Park in Orlando that's slated for the second half of 2026. So they're curating the physical presence carefully.
Okay, that makes sense. So that's pillar 1, smarter retail expansion. What's pillar 2?
Pillar 2 is advancing their digital transformation and omni-channel strategy, making digital and physical work together seamlessly.
How's that going? Are online sales strong?
They are. E-commerce demand was up over 15% in Q2. But here's the really interesting part. The digital strength seems to be driving physical traffic.
Really? How so?
Domestic store traffic actually rose 3%. Now, compare that to the national retail benchmark for the same period, which saw traffic decline 3%.
Wow, so they're outperforming the average by 6 points. That's huge.
It's a massive swing. It suggests people are using the digital tools to lead them back to the physical store.
How specifically are they doing that? What's the mechanism?
Well, the website acts as a really effective planning tool.
Mm.
Apparently, the most visited pages are Find a Store and Plan a Visit.
Ah, so people aren't always buying online. They're using the site to organize their trip to the workshop.
Exactly. They're planning that high-value, high-margin physical experience online.
And social media must play a role in sparking that initial interest.
Definitely. They use Instagram, TikTok, YouTube, all that to, as they put it, spark trends. They gave an example of the fruit stand assortment.
Fruit stand, like fruit-themed bears.
Yeah, things like the watermelon frog, apparently it went viral.
Yeah.
These kinds of unique collectible items drive huge buzz online. They said that campaign generated triple-digit growth in media impressions.
So use social media and unique products to create desire online.
And then funnel that desire into a planned physical store visit where they can capture the higher transaction value.
Clever. Okay, that brings us to pillar 3.
Pillar 3 is about leveraging their brand equity and diversifying, moving beyond just the traditional workshop model.
And is this where those little mini beans come in?
Exactly. This is a big strategic move. Mini beans are smaller, collectible plush figures, priced lower, around $10.
More accessible then.
Right. They launched in February 2024, and get this, they've already seen an 80% year-on-year revenue jump for that line. Things like a dragon fruit dragon, a candy corn longhorn, they sound kind of fun.
80% growth already? That's fast. What's the bigger strategy behind them?
The mini beans allow Build-A-Bear to become something new, a hybrid CPG, consumer packaged goods, and retail brand.
How so?
Because the mini beans are perfect for their new wholesale business. They can place these smaller packaged items in channels where a full Build-A-Bear workshop wouldn't fit.
Like where?
In airport stores, they mentioned Hudson. Upscale convenience stores, they partner with Apple Green, over 50 locations there. International toy stores run by partners.
Ah, so it gets the brand outside the workshop walls, diversifies where they make money.
Precisely. Reduces reliance on just the mall or destination locations.
Yeah.
And they're also really good at using seasonal pushes to drive sales for both regular and mini items.
Like Halloween.
Yeah, they mentioned positive signs for Halloween 2025 already. They brought back a vault favorite, the Pumpkin Kitty.
People love those vault releases.
They do. And they have new stuff like a scary cute zombie axolotl. They've really perfected timing these releases, especially licensed ones, to hit those seasonal collector peaks and drive high margin sales.
Okay, so it sounds like a lot is going right, but no business operates in a vacuum. What about challenges? Headwinds?
They were pretty upfront about those. They acknowledged facing a wide variety of economic challenges and geopolitical shifts. They know there are risks.
What specifically?
The big ones are U.S. tariffs impacting imports from China and recently doubled tariffs on goods from Vietnam, plus rising costs internally for labor and healthcare.
Okay, those sound significant. Did they quantify the impact?
They did. They expect a total headwind of nearly $16 million for the year, about $11 million from tariffs, and another $5 million from those extra medical and labor costs.
$16 million. That's a decent chunk out of their profit. How are they managing that?
Well, for the tariffs, their sourcing strategy helps. They use dual sourcing factories in both China and Vietnam.
So they can shift production if tariffs spike in one place.
Exactly. It gives them flexibility for production and global distribution. Smart planning there.
And what about passing costs to consumers? Are they just raising prices?
They are doing some price increases, but they describe them as selective and strategic, often timed with those seasonal product resets, targeting collectors who might be less price sensitive.
But not across the board.
It seems not. They emphasize staying focused on keeping the core animals at attainable price points. They don't want to price out families.
And that birthday program probably helps keep the entry point accessible too.
Absolutely. The Count Your Candles program, where kids pay their age for a special bear during their birthday month, it's essentially a marketing cost for them, but it's brilliant for acquiring new loyalty members.
Guarantees a steady stream of new customers, which means they don't have to rely solely on price hikes.
Right. It helps balance things out. And ultimately, as the source material points out, their transaction growth isn't just about units sold. It's up because they're selling stories, not just selling items.
Back to that emotional connection.
Yeah. That whole experience model lets them drive higher dollars per transaction based on more than just the cost of the plush toy itself. People add clothes, sounds, accessories.
Right, the whole customization aspect. Okay, so let's try and wrap this up. If you had to summarize the Build-A-Bear success story for our listeners.
I'd say it's really a playbook for how a legacy physical retailer can achieve durable growth today. It's through smart, aggressive diversification.
Diversification across.
Across everything, really. Targeting new customer segments like Kidults, expanding globally with that capital-light partner model, developing new product lines like mini beans to enter wholesale and CPG.
And it's all built on that core emotional brand experience.
That's the anchor. Without that strong brand feeling, none of the rest works nearly as well.
Which brings us to one final, really fascinating point from the sources, where they might be going next.
Ah, yes, the tech angle.
Right. The sources mentioned Build-A-Bear is investing in social listening tools and even experimenting with AI influencers.
Which is interesting, given their target kidult market. That's a demographic, remember, that reports feeling anxious about the economy, about AI itself and seeking comfort.
The same group that tells their secrets to teddy bears.
Exactly. So if Build-A-Bear's mission is genuinely to add a little more heart to life, how could they use these new digital tools, AI even, to enhance that core emotional physical experience?
That's a really interesting question. You think about that moment in the store, the heart ceremony, where you make a wish and put the heart inside the bear.
Right. If they're using social listening to understand the emotional pulse of their audience, what could a digital heart ceremony look like? Could AI help craft the story for a specific bear, tailored to what someone needs?
Could they even sell some kind of digital emotional support through the bear, tapping into that anxiety?
It's definitely out there. But for a brand built on physical comfort and emotional connection, figuring out how AI fits in, that's the next, maybe unexpected frontier for the teddy bear empire.
A truly provocative thought to end on. Thank you for unpacking all that with us today.
My pleasure. It's a fascinating case study.